Reporting quality refers to the degree to which financial statements faithfully represent a company's underlying economic performance and financial position. The program emphasizes that high-quality financial reporting provides transparent, relevant, reliable, and decision-useful information for investors, creditors, and analysts. Financial reports should accurately reflect economic reality without intentional bias or manipulation. Reporting quality is essential because investment decisions, credit evaluations, and market valuations rely heavily on financial information. When reporting quality is poor, investors may misinterpret profitability, liquidity, and risk, leading to inefficient capital allocation. Analysts therefore assess reporting quality carefully to determine whether financial statements provide a realistic basis for evaluating current performance and forecasting future results. High-quality reporting differs from high-quality earnings. A company may report unusually strong earnings because of one-time gains or temporary favorable conditions, yet still provide high-quality reporting if those circumstances are clearly disclosed. The program explains that earnings are considered lower quality when a large portion of net income comes from unsustainable sources such as non-recurring gains. However, transparent disclosure of these items supports strong reporting quality because users can identify the temporary nature of earnings. Analysts therefore distinguish between the sustainability of reported earnings and the reliability of financial reporting itself. Transparent disclosures improve decision-making even when short-term earnings performance is weak or volatile. Neutrality is a fundamental characteristic of high-quality reporting. Financial statements should present information objectively, rather than favoring overly aggressive or excessively conservative accounting outcomes. The program notes that reporting is most decision-useful when accounting choices are neutral because both aggressive and conservative accounting can introduce bias. Aggressive accounting may overstate revenues, assets, or profitability, while conservative accounting may intentionally defer earnings or overstate liabilities. Although conservative reporting may appear safer, it can still distort economic reality and reduce comparability. Analysts therefore evaluate whether management accounting choices faithfully represent underlying business performance rather than serving short-term strategic or compensation objectives. Management incentives play an important role in influencing reporting quality. Companies may face pressure to meet analyst expectations, maintain stock prices, satisfy debt covenants, or achieve compensation targets tied to financial performance. These incentives can encourage earnings management through aggressive revenue recognition, delayed expense recognition, or biased accounting estimates. The program identifies motivations such as meeting earnings benchmarks, improving market perception, and enhancing management compensation as common drivers of lower quality reporting. Analysts therefore review accounting policies, unusual transactions, and earnings trends carefully to identify potential reporting distortions. Understanding management incentives improves assessment of whether reported results genuinely reflect operational performance and long-term economic sustainability. Strong corporate governance, internal controls, and independent audits are essential mechanisms supporting reporting quality. Effective oversight by boards of directors and audit committees helps reduce opportunities for manipulation and financial misconduct. Independent auditors provide reasonable assurance that financial statements conform to accounting standards and are fairly presented. The program explains that regulators in most countries require public companies to obtain independent audits and that auditors may issue qualified or adverse opinions if financial statements contain material misstatements. Analysts examine audit opinions, disclosure transparency, and governance structures carefully because weak oversight or ineffective controls increase the risk of unreliable financial reporting and accounting fraud. Evaluating reporting quality is essential for accurate financial analysis, valuation, and investment decision-making. High-quality reporting improves confidence in earnings sustainability, asset valuation, and future cash flow forecasts. Analysts integrate assessments of accounting policies, disclosure practices, governance quality, and management incentives to determine whether financial statements provide a faithful representation of economic reality. Poor reporting quality can lead to overstated valuations, underestimated risk, and costly investment mistakes. Transparent financial reporting supports efficient capital markets by reducing information asymmetry between management and investors. A strong understanding of reporting quality enables analysts to identify potential warning signs, evaluate earnings reliability, and make more informed investment, lending, and valuation decisions within increasingly complex global financial markets.